before we get started, I just want to make a reminder to everybody that the information discussed today is not to be interpreted or construed as investment advice. Everyone's financial situation, goals, and objectives are different. Please consult investment advice.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble. Welcome back to the Loonie Hour, episode 37. As always, joined by the three amigos. We got Rich Diaz of Acorn Macro Consulting, and we've got everyone's favorite boomer, Keith Dicker, with IceCap Asset Management. Keith is in the mountains with some mountain fever. That's what we're calling it. So he's a little under the weather, so he'll be popping in and out of me, mostly Rich and I taking control of the show here. Rich, what's going on, man? What's new with you?
Not much. Congratulations on last night's another illegal victory for the Colorado Rockies. Is it? What are they called?
We'll take it any way we can. I'm
Bettman's got your boys back.
I thought that goal was in, and it reminded me of like Patrick Kane in 2010 when they won the cup there.
That's right. I really like Nazem Kadri. I think he got a raw deal in Toronto, and I think he's and the bullshit that he had to deal with in St. Louis was out of control. So I'm really, really happy for him. But it was definitely too many men in the ice. Anyways,
hey, we don't talk about that. But anyways, yeah, no, I'll be in Colorado actually the day that this podcast is coming out. So tomorrow, Friday, I will be in Colorado for Game 5. I bought my tickets before the series started for Game 5, so I'm hoping this all works out for me as a long time diehard Avalanche fan. But speaking of that, that's maybe a good segue. I bought some Avalanche tickets to Game 5, and I could not believe the ticket prices.
Yes.
I was just like, man, how do normal people afford these tickets? Like, I just don't understand. They were like, I'm up in the nosebleeds in the upper bowls. I'm like at the top row, and because I'm cheap as hell. And they were like $1,500 a ticket. So I had to get two because my wife's coming.
Is she a big hockey fan?
No, but she wants a vacation. So moral support, I suppose, is what we're calling it. But anyways, yeah, $1,500 a ticket. And I mean, that doesn't include all the beers, the food,
hotel.
I was like, holy smokes, man. Like,
ballers like you and Keith can afford something like that. But I think it's good, man. It should be once in a lifetime event. Hopefully they win for you.
Go ahead.
Hey, Steve, what are they cost now? Like on StubHub?
They've gone up a little bit. I was joking. Maybe I should flip them and
shame on you.
No. But it was like, they're like $2,000 now.
So I've been trading.
That's one of my better investments of the year.
I've been trading NFL tickets like on StubHub for a few years now. You know, it's quite the game.
That's how you afford that nice house, eh?
Yeah. The 49ers have paid for it.
That's amazing. How often? How many games a year do you go to 49ers?
We'll do one a year. We'll go see one game a year.
That's a long haul from Halifax.
Well, sometimes you choose an away game. So you always go for the location, like where's it going to be fun? You do it that way.
So I've got two questions now. This is kind of a good segue here. Is one, these ticket prices outrageous, so we clearly have an inflation issue here. Canada's CPI inflation, Rich. I know you broke it down for everybody on Twitter the other day, but maybe just walk us through that. I guess it was, and we had cautioned people before, right? Keep in mind the CPI basket was changed or updated from Stats Canada. So they've now added used car prices to the index, which is what the US has been doing, for, I don't know, decades. And so that's why everyone it's hilarious because like Krista Freeland's like, testifying in the House of Commons, being like, our inflation rate is like not that high in relative terms to the rest of the G7. And then she points like the US. And it's like, listen, lady, like, first of all, you guys are completely calculating CPI using different methods and baskets. So they've now added used car prices, hence the huge ramp up in Canadian inflation print. So don't take that as like, oh my God, inflation is like accelerating at a rapid pace. But Rich, maybe break it down for us a bit further.
Yeah, sure. I'm going to push back a little bit on the used car thing, but Christina Freeland definitely flat out lied about that. Okay, so let's just get it done. So 7.7 was a 39-year high. The last time that happened, Mike Bossy and Brian Trottier won the 4th Stanley Cup for the Islanders. I try to have a little bit of fun on Twitter. I think everybody takes themselves way too seriously. So, I mean, it's a brutal number, 7.8 and 7%. Sorry. Shelter, which is a component that I've been talking about for a long time, it has been a really like a large contributing factor to that. And it actually is now, Shelter is now at 7.4%. And so it contributed 2.9 out of the 5 from core. So you can start to see these numbers.
Isn't that funny though? Like just to kind of put that in context for everybody, that like the inflation basket, which covers shelter, is now finally rising as home prices peaked literally like 4 months ago and are now rolling over. So it's like, I don't know. I just feel like a lot of the data that policymakers are ultimately using and using to basically set the price of money is kind of like not bad data, but like lagging and like not necessarily, I mean, they're doing their best, but it is kind of funny.
Yeah. Listen, someone the other day said to me, isn't the CPI basket totally screwed up and isn't it a bogus calculation? I was like, oh yeah. Okay. I was like, yeah, it is. You figure out a better one. And so you have to balance the criticism, which is, I think, justified. You have to also balance the reality that, no one really can do probably a better job or wants to do a better job. So it's just about, I think it's about sort of looking at all different indicators together and not being willfully blind to the data, as I think, and I'll get on to why I think that's an important little sort of a dig at the Bank of Canada. But anyway, so important things, services is really important. Services, for people who don't know, is much stickier inflation. So if you look at my Twitter thread, you'll see, goods bounces around, obviously, because it's, related to food and fuel, which is much more cyclical and much more sensitive. But services inflation got up to 5.2, which is, again, I can't remember exactly how high that is, but that's a real high. And that's, so what we call is stickier. And that's like a 20-year high. The last time it was this high was in 1990 or 1991. So again, just to remind everybody, services inflation is stickier. Why? It's to do with a lot with more labor. It has to do with more labor. It's more linked to labor markets. And it's not as cyclical. It's not as sensitive to import prices or currencies, etc. Then there's energy prices, which I thought was crazy, which is 35%. The reason I bring up energy is not to remind everybody how expensive their trip to the gas station is, but to remind everybody that if Canada wasn't one of the largest exporters of oil in the world, that number would be way, way higher. And our currency as a function of that would be much lower. People have heard me talk about that before. And then the final one, the final two things, which is food, which is just, it's such a shame. I think what people don't get is like a lot of these policies, a lot of this inflation, has as a function of supply chains constraints. Yes. But I reiterate the kind of, generational expansion in the balance sheet to basically provide cover for an incredible deficit. And the amount of money that was spent as a percentage of GDP is just, double what it was in 2008 with no necessarily discernible improvement we're not really sure. I imagine the jury is still out on whether or not we got our bang for our buck there. And then the final thing that I think was really important, and the chart that I always say the same thing because I guess, I'm a broken record, but it's the chart that really should anger Canadians when they look at it. It's the core inflation. So it's excluding certain items that might be subject to supply constraints or cyclical factors. And the Bank of Canada created this, in their infinite wisdom, called the 3 preferred measures of core inflation. I suggest all of our listeners just throw that into the Google machine. And you can see that they designed it to capture persistent price movements by eliminating transitory or sector specific fluctuations in CPI. If it sounds like I was reading that, it's because I was reading that. That's literally their words. And you can see those numbers were starting to rise rapidly at the beginning of 2021. And the BOC just ignored them for some reason. They were well above the target, the stated target of, plus or minus 1%, above or below 2, so 1 to 3, by early 2022. And you can see now one of them, the one based on a trimmed mean approach, is like almost 6%, and it's not slowing down. So that's the story for the inflation piece. I don't know, Steve, if you wanted to. The used car thing. Sorry.
Okay.
The used car bit was new. Sorry. The used car bit was new. I actually went and read the release from StatsCan, and they argue that there wasn't actually such a big influence on this on this particular print, is what they said. I put the link in my Twitter thread.
Because used car prices are finally rolling over. Keith's Porsche is finally going down in value.
Yeah, so that's, I can't speak to that. I did read the really boring note. Like you mentioned, the US has had used car prices in the CPI basket for years. Canada has sort of ignored it. CPI at one point contributed almost like a third in the US. It contributed almost a third of the increase in headline inflation. It was an incredible number. How does that work out? Well, if you have a 40% increase in something that weighs about 5 or 6 to 10% or whatever in your basket, you can get a significant boost from specific items. The same is true, by the way, on the way down. A couple of years ago, there was something to do with mobile phones. When mobile phones, prices all got cut, and you could see the incredible decrease in the inflation. But yeah, so that's the inflation roundup. I know people are sort of tired of it because they'll complain that those numbers are far too low and they don't reflect their own baskets. I sympathize with that view completely.
You know what gets me going? All these inflation apologists that are like, yeah, it's a world phenomenon. We should not be blaming governments and like the Trudeau government. It's like, really? Krista Freeland is now coming out with basically another helicopter money drop. Like this is just like, nobody wants to win. And this is what we've been talking about this show, right? Like we said it months ago, which was like, they will fight inflation with like more stimulus checks. Because like we're in a society now where nobody wants to stomach any sort of pain. It's always like, oh, woe is me, and nobody should be able to go bankrupt, and nobody should suffer any pain. So let's just give them more money, give them free dental care, give them everything they need to stay elected. And like one of the policies is from Krista Freeland is she's going to cut a $500 check to like 1 million renters in Canada. And it's like, I get it. Like we want to help these people. They are suffering, but like this is actually going to hurt them more. Like you need to you've got the central bank, which is aggressively raising interest rates in order to like quell inflation. And then you have the government doing the exact opposite, which is, well, let's give them more money. And so it's really mind boggling, to be honest. And then nobody holds them accountable.
I mean, we don't hold them accountable. It's our fault as voters. I think it's important to sort of recognize that. I think you can call your MP. I think you can write emails to them. I hope they take that a little bit seriously. As far as handing people money, I mean, it's the argument I've sort of made with a lot of these handouts. It's just a transfer of wealth from the government to the landlords. That's what people don't sort of get. I think it's very short-sighted. Yeah, sorry, go ahead.
Well, I've got a crazy story just on the rental side of things, like because you're talking about like subsidy to the landlords and stuff. I mean, let's call it what it is. Again, I think like at the time it was probably good policy because like we would have had like a economic depression. But like let's call it what it is. Like, and I'm in the business. It's like these like mortgage deferrals and whatnot. Like, while they were good policy, it was kind of like a bailout for homeowners.
It was,
and then ultimately, they said, okay, we can't evict anybody. So we'll basically subsidize the landlord's rent. So you keep your tenant in there. If the tenant can't pay the full rent, we will subsidize you. And now, just crazy story. So I'm here in Vancouver. I was chatting with a guy in our office there and he goes, yeah, my client just bought into this building and And so he rented out this unit. I've actually sold in this building before. It's like a 55-year-old like building in East Vancouver, like decent neighborhood, but like it's like the one of the oldest like buildings in Vancouver. Like it is not a nice building. And they had a 1-bedroom rental in there. The guy, his client just rented it out. He says he got 50 applications and he rented it out for $2,400 a month, a 1-bedroom, like 600 square feet, like not in great shape. It was updated maybe 15, 16, 17 years ago. Like, and so that was $2,400 a month. That unit pre-pandemic on the high side would have been like 1,900. So we've seen this like massive, like the rental market in Vancouver right now is like insanely hot, despite everything what's happening in the resale market right now. So
I mean that's why the shelter component is such an important contributor and factor going forward, and something we should all sort of keep an eye on. Besides the fact that it's 39% of core CPI basket, I think that there's still pressures on that number coming from population growth. But coming from handouts, coming from a bunch of stuff. I don't know. Go for it.
The way that so I'm not entirely sure on how StatsCan is calculating like the shelter component. Isn't it like homeowners replacement costs? So that would like be more attributed to construction costs.
Yeah, so it's definitely part of that. There's different parts there, right? There's definitely an owner, like this. There's like an owner accommodation measure, which it includes sort of like the operating costs of a house.
Yeah, but it doesn't necessarily track. Is
Right.
it not necessarily tracking like rents and like home?
They try
price?
to. One of them is I've posted it before, and we can share it. Which is it does track rents.
Okay.
There's rental accommodation. That's one of them. There's owner accommodation. That's another one. There's like housing operational costs that are included in that. Those operational costs obviously are very subject to supply chain constraints. You can see that some of them have blown out.
Well, what I will say is that I just know from the rental data. So for example, like a lot of the media will quote like rental data from like CMHC. And that's, I think, how it StatsCan uses is CMHC's rental data. Is CMHC just surveys property managers of commercially operated buildings, basically. So they contact like professionally managed apartment buildings and they survey them based on like, hey, what's your rent roll? But like they're not capturing like rent turnovers for one in the grand scheme of things. And then number two is you're not capturing the massive private landlord market, right? Like most condos or most like places that you go to rent, you're typically renting from like a mom and pop, right? Some 60-year-old dude that's got, a 1-bedroom condo that he wants to rent out and that's his retirement thing. Like that's typically who you're renting for. So they don't survey that guy. And like he'll typically have more turnover, right? So anyways, long story short, the data that we're operating under is certainly not perfect. I actually have a kind of, someone's been floating it out there of like the idea that like interest rates, like what a novel idea, like interest rates should be set by like the private market. Like the market, like I was kind of curious, like, I don't know, like it's apparently that used to be a thing back in the day. Like Keith, I don't know, you're old enough to know, but how would that work? Like,
I remember those days. So first of all, though, I feel like, the hockey analogy here, how like you make it to the finals and there's always like the aging veteran that holds on for one last year and they let him play in the 7th game or whatever to get the cup. Like, I feel like I'm Lenny McDonald right now. You guys are carrying me today, so that's pretty cool. I like that.
You're welcome.
It's playoff time. Keith's grinding it out.
Like I'm out. I can't even look around the ice. You guys are going so fast. But yeah, years ago, before the Bank of Canada, they didn't actually set rates. It was set by the market. But it's really not that big of a deal. Even if the central bank sets overnight rates, which they do, the rest of the yield curve is set by the market, unless of course you have a lot of QE involved, which is of course happening today. I always like to say that the global yield curve has been suppressed now for probably 12, 14 years. But in a normal economic monetary environment, yeah, the market does set the rates. And then they set credit spreads as well, of course. So So that has a big impact on it. But probably though, like the next big thing, yesterday Powell was speaking, and he's talking about his commitment to bringing down inflation, and his word he's used was unconditional. So this goes back to the narrative that we introduced a few shows back, that it's likely central banks are trying to create a recession to really crash demand. So you think about what's happened over the last few weeks. So the narrative has shifted from we will have an economic slowdown to now, okay, maybe we'll get flat growth, to now it's okay, we're going to hit a recession, but it's going to be a soft landing. Do you see how it's happened steadily over the last few weeks? Now, even one of the Wall Street firms came out and said, yeah, we're going to have a recession, most likely Q4 this year. So we happen to, here at IceCap, I suspect that the probability of a pretty good recession is a lot higher than people are thinking. And so that's going to have a big impact on markets going forward. So think about all the markets that have been grinding lower and lower over the last couple of quarters, like Japanese yen, for example, the 10-year. I can totally see them having a good rally for a month or two. Oil could come off. Oil could come off pretty hard in that. And if you see these movements taking place, don't be fooled into thinking it's the start of a new cycle where that trend will become linear. Like, it could just simply be your opportunity to buy more oil, or to short yen again, or short the 10-year again. But remember that the narrative is changing. Now it's becoming more acceptable to talk about a recession coming. So I think that's where we're definitely going to be headed.
So, well, Jay Powell was out, I guess he's testifying yesterday and today, I guess. So one of the reporters was asking him, or members of parliament, or I don't know, what do you call Senate? The U.S. there? Anyways, I was just saying, and Powell basically came out and said, yeah, like, we have to try to engineer a slowdown, and engineering a soft landing is going to be a difficult task, right? So I think these guys kind of know, like, in order to get inflation down, and also engineer this magical soft landing, which, we had the Bank of Canada's Tiff Macklem talking about a week and a half ago, right? We're aiming for this soft landing, and I think it's going to be incredibly difficult to engineer a soft landing when you have inflation at literally 30 to 40 year highs. So, and then, one of the ones you'll enjoy, Rich, there was I don't know, who was that? I don't know, some Republican, I can't remember where he was from, but he's like, inflation is hitting my citizens so hard that they are coughing up bones. And so like that, actually. Yeah, and Powell's there with a straight face, but he was basically asking, like, would it help inflation if we had more refining capacity?
I heard that.
And
I mean, it would. Obviously, refining capacity, we've talked about this before. Refining capacity is a 7-year low in America. In Canada, we've refined the exact same amount of oil as we did 20 years ago, which is like 1.9 million barrels a day. It's for different reasons, slightly different reasons, but in general, there's not enough refining capacity, and that definitely affects oil prices, especially gasoline prices. We've talked about the crack spread before.
Crack spread, drink.
But just like one thing on the narrative, I think is really, and you were touching on that, and I sort of got sidetracked, but I want to just get back to it if I can, which is, Keith talked about the narrative around recession. Well, I want to bring it back to the narrative around inflation. And, in my early days of Twitter and putting stuff up, I made this video called The 4 Stages of Inflation. And I ripped it off of this show, again, second mention in 2 weeks about Yes, Prime Minister, but how there was like 4 stages of dealing with foreign policy. So I swapped that round and I wrote down the 4 stages of inflation. I think it's worth us just reminding us of sort of where we've come and where we're going. And the first stage, of course, was to say that there was no inflation, or that none of the policies would be inflationary. And I think it's important to remember that, even though there was many people out there saying, listen, deficits plus, this is going to end badly. And then the second stage was, but there is inflation, but it's lower than you think. And I remember reading articles about how the CPI baskets weren't appropriate for the corona and this and that, and had these missing pieces, and there was too many of the wrong. There was flights in there where there shouldn't have been, and there was this product in there when we should have taken it out. And then the third and the best stage, of course, was that it was transitory. So that was stage 3. And then you just touched on it, and I think it's important that we get back to it a little bit, which is the fourth stage was that the inflation is good for you. And I think that that's the most insane stage, and it's you clearly seeing it. The narrative has absolutely moved to that fourth stage. I've gotten a lot of things wrong in the last couple of years. I definitely got that right. And this idea that inflation somehow is good for people, especially poor people, I think is just such a nasty kind of, it's such a bait and switch. I think if you're not paying attention and you don't write, I write notes sort of every other week and sort of I've got the receipts, shall we say, but it's such a pernicious thing. And I think it's so important that we sort of remember the narrative and remember that sort of the wool is trying to be pulled over our eyes. And now we're reading, whether it's, I'm not going to mention newspaper's name, but how inflation is meant to be good for us. And I just call bullshit on that. Inflation is not good. For especially we're talking 8s and 9s and 10s and 15s and 30s. If inflation's 1 or 2%, I can sort of wrap my head around that being okay for people. But to have it this level and then to blame it all on sort of supply chains, I just think it's just such bullshit, such a lie.
Hey, Rich, how is it positioned as being good for us? Is it from the wage side or?
Yeah.
What?
So one of them is like, one of the articles I read was that, you can demand higher wages, which of course is dumb because obviously inflation's outpacing wages. The other one was like, oh, it's about debts. So if you have lots of debts, technically the real value of your debts are going down, which I guess is true. But make no mistake, if you own real assets and you are highly, highly levered, which is generally people with larger mortgages, people who, have huge equity portfolios like Keith, got lots of money. Those inflation, the value of his real assets it will stay. Didn't necessarily go up all the time in real terms, but there's just, it's an easier fight, let's say. People who get a lot of income from dividends, those dividends are paid in real terms, just as a function of they're paid every single year. And so it's just amazing to see that narrative switch around. It's just, I really want to do an oil rant despite Steve's objections, but it's the same bullshit around, about energy and how those narratives have changed. Biden recently is cutting taxes on gasoline, and talking about how these, oil companies are not producing enough oil. Meanwhile, they've done sort of everything in their power to restrict the supply, to constrain output and capacity. Sorry.
Did you see the public fight on Twitter with the CEO of Chevron and President Biden? I don't have I don't know if I have it in front of me here, but the CEO of Chevron was basically fighting back. Chevron responds to President Joe Biden. Addressing the situation requires thoughtful action and a willingness to work together, not political rhetoric. Your administration has largely sought to criticize and at times vilify our industry.
That's obvious to anybody.
And then he goes on, Chevron will engage in this week's meeting with Secretary Granholm. I encourage you to also send your senior advisor to this meeting so they too can engage in a robust conversation. But anyways, I think Biden was fighting back, or he made some comments saying, Chevron's quite sensitive. But it is, the ultimate sort of summarization here is, that oil industry has obviously been vilified, right? Like they're the bad guys. They're the guys for, causing climate change. At least that's what it's been made out to be from the media. And now all of a sudden that we're in a shortage and rising fuel and gas prices and your standard of living is declining. Everybody's asking them to sort of fire up the pumps and ramp up, refining capacity, et cetera, et cetera. And it's not that simple, right? I'm not an oil expert, obviously, but
neither am I. I know.
But what does it take for a new refinery? Because these are like 7, 8, 9 year projects, just like to start. So like you have to kind of like as an oil executive, you got to look basically like 10 years out and say, is it worth the capital investment here when every level of government is basically trying to penalize us from further investment, but they want lower
I think
prices.
the other thing that I think people just, stepping back, like before we get into that, because I think it's really easy to lay it on. I have a lot of arguments and a lot of charts, but I think what people don't really appreciate is how difficult and kind of how scientific refining oil is, and how many PhDs in chemical engineerings and PhDs and master students in the pressurizing pipes and getting hot fluid to travel through pipes with corners, the 90-degree corners, and up and down, and how scientifically rigorous and difficult and challenging it is to create an efficient and effective refining facility, and how much money it takes. And money means staff, highly technical, well-trained, competent staff, and obviously the capital expenditure on the structures bit and the equipment bit. And so like this idea that you can just like, after, again, just to reiterate, like, let's use real numbers here. In 2021, refining capacity was roughly like 8.75 million barrels per day in the US, and now it's 17.9. So that doesn't sound like a lot, but that's a 7-year low. So, and those refineries are running at a capacity utilization rate of like 94%. And you say, well, Rich, why can't they go to up to 100? Well, because there's frictional utilization, right? Do you know what I mean? In the sense you need to turn it off for maintenance and whatever. So that's the first thing. And why is that important? Because we've talked about it, the crack spread, which is the difference between the refined and unrefined product. And normally those crack spreads are around $20 US a barrel. And now they're at 60 and they refuse to fall. So that's the other sort of angle that I think is really important. And then obviously, we've talked about, and then there's inventories, which are very, very low. And then that's related to the ability to pull oil out of the ground. And why is that low? Because capital expenditure relative to either sales, total assets, GDP for most of the Western liberal democracies is at 10, 15-year low. In Canada, your CapEx spend on mining and materials and related to that is, now I'm looking at it right now, is like less than 1% of nominal GDP. And that's a low that's not been seen since 1993. So, you sort of, I think that's just, it's just like, there's no flexibility in the system. And I would argue, again, as I've mentioned before, it's an own goal. And I think that, but more importantly, I just think we take it for granted. I think when things become ubiquitous, when they're everywhere and we touch them all the time, like just think of how amazing your cell phone is as an example. I mean, your cell phone, you literally have a supercomputer in the palm of your hand that can take better photographs than 90% of other cameras. You can talk to anybody in the world, the click of a button. You can search up any. We start to take these kinds of technologies for granted. And I submit to you that the technology of fossil fuels, specifically gasoline, not so much coal, because there's not that much to it. You just pull it out of the ground and you throw it in a machine and you burn it. But the ability to refine and use petroleum products has basically we've taken it for granted. And I think we're learning that lesson really the hard way. I think, one thing I think we don't talk about enough is the sanctions in Russia and how basically that's just going to absolutely destroy Europe. Why? Again, because Europe produces no fuel and yet consumes roughly 9 million barrels of oil a day. It's like, so I think it's just that it's sort of an arrogance, I think, that really kind of bugs me. I mean, it's a lack of respect for all of the brilliant men and women who work as engineers in that industry. I don't know, maybe I'm too romantic about it, Steve, but I just think it's a shame, really.
Yeah, no, I mean, speaking of which, seems just looking at some tickers right now. So, I mean, we got a nice little sell off here in oil and gas, as Keith has kind of talked about, right? Keith, how are you kind of looking at markets right now? We've kind of had this commodity sell off. I mean, I'm watching the price of lumber in particular because I've started construction on my new property in Calgary. So kind of why I'm watching the commodity space quite closely, because well, I am going to get hit hard on these increasing of financing costs. It looks like some of my building costs are finally starting to come down. Lumber's gotten whacked pretty good here, but how are you looking in general at the commodity space and kind of what that's indicating to you, right? I mean, quite a good move in the last month or so.
Yeah, I think the markets now have clearly shifted away from the inflation story to more now we're heading towards a slowdown or a recession story. And I think this might play out over a few months. And I do think that the probability of it's some pretty dramatic declines in economic activity data is going to come at us. And we would use that as an opportunity then to load back up on the commodity story. So for you, you might get a break in the near term. I doubt you'll get break on wages or salaries for these guys working for you. But the commodity sell-off right now, it is being, again, the recession narrative, it's coming at us increasingly. Every day you'll see it. And at the same time, the central banks, they're not going to stop raising rates, as Powell said yesterday. I think one thing that to touch on as well, and I think, Rich, you might have some information as well. So whatever happens in the US will likely happen in Canada. So if down in America, if they're going to cut taxes on gasoline, maybe we'll get some kind of an equivalent up here. I don't know how it would look or feel. But the other difference, though, is that down in the US right now, the White House is very weak politically, so that they have to do this. Whereas up here in Canada, I think the coalition between the Liberals and NDP is pretty strong, right? So maybe they don't have to be as aggressive with, some kind of a benefit for oil prices or gas prices, I guess.
If you look at that Nanos, I subscribe to their service. The Nanos polling in Canada, actually, I mean the lead, the market share, the gain from the Conservative Party has been quite noticeable. They're actually in the lead in terms of polling right now, which is quite unusual because the Liberals have been leading that for years. So I do think, like, I agree with you. Yeah, you've got that coalition, which is obviously holding up pretty strong, but I think there's a lot of angst and disruption in society right now. People are looking for fingers to point. Who to blame?
I have some ideas. I think just a last little thing on the commodities thing. You say, Rich, why would like oil? We get it. I think I've explained that bit, but why might commodities have a similar trajectory in terms of maybe having a short-term pullback related to the recession narrative, but ultimately stay relatively elevated? And I think it's the lack of supply in the system. And how do you determine supply? There are different ways. Obviously, there's inventory levels that's harder to figure out. But often what I like to look at is, again, sort of things like CapEx, so capital expenditure, the same CapEx metrics that I would use to like see what's potential as far as what's in the pipeline for oil. I would use basic materials and basic resources. And again, we're at, I'm looking at it right here, relative to total assets, we're at like basically 30-year lows. And just one thing on commodity prices, I think people sort of need to sort of wrap their head around is, like, commodities are terrible businesses. Commodities are commoditized in their that is to say that they're fungible and interchangeable. And so what you should have is your marginal, like from an economics, like nerd speak, you should have your marginal revenue ultimately meet your marginal cost. And, you shouldn't, as a commodity producer over the long term, you shouldn't really be making any money, in inverted commas, over the long term. There are just periods where your marginal revenue exceeds your marginal cost, but then someone enters the market and then sells the commodities they have so that their two curves match and you're back in equilibrium. And then you start to not necessarily lose money, although you may, is that you no longer are profiting wildly. And that's the trick right now. We're in a situation where your marginal revenue is well above the marginal cost as a function of these supply constraints, whether it's in oil and gas or basic resources and stuff. And I would argue that that's going to persist a long time, even if you do have some kind of recession or something like that. But anyway, we can probably switch gears now. But
Well, no, I was going to ask, I mean, Keith or Rich, I mean, how are you looking at the markets right now in terms of like, I mean, I'm looking at XLE, which is the energy ETF today, down 4% on the day and off from its high, it's off about 25%.
yeah,
Is this kind of like, are we nibbling here? Is this like the part of the reload or I mean, or is this like part of a larger flush out here, Keith, where, you know, ultimately, again, Fed hikes, things break, which, you know, when things break, you have a liquidity crunch and everything sells off.
No, I think it's just a lot of rotation taking place. So, you know, Rich was very, his timing was perfect, and he was very, you emphasized that energy theme from day one is absolutely correct. And there are a lot of other managers did that as well, that they're running like very large books. So they've made a lot of money. Now, you know, we're getting halfway through point of the year. Recession talks are coming up. A lot of that's just people taking money off the table. They're rolled into something else, like maybe a value play or something. But everybody that made money on that theme, they love that theme. And as Rich points out, like not a lot has changed in the long-term narrative with that view. So I suspect if oil does, I do think it will come off here. As will the energy stocks as well. I can see that money going right back into it again. So, you know, I think it would be maybe the potential for one of these reloads coming up.
but there's also another thing that's just like things don't happen in a straight line, and I think it's very dangerous in a sense to expect. Even for me, who I'm very well aware these businesses are shit businesses, and I'm very well aware that the setup was quite excellent for them. It's still pretty good, but there are clear risks. And then I agree with Keith as far as the profit taking. But the reality is, you know, things are you know, we talk a lot about technical indicators and sentiment indicators, and there's something called like an RSI, which is a relative strength index, and things are often overbought. And what that means is people are like, you know, you are wary. Damn it, I always screw that up. But anyways, people always, you know, are very cautious about how fast you've moved in that certain space. I also think that there's also the interesting rotation we've seen, Steve. I don't know if you've noticed, which is sort of some people bottom feeding and nibbling at some of these tech names that we've looked at. You know, companies. You know, that used to be trading at 30 times forward earnings and are now trading at 18 and 17 times earnings, which is like the Googles and some of the US big tech names. I don't know. I think that there's definitely a little bit of sort of rotation into that as well. I don't know.
Well, yeah, I mean, Facebook's been dead money now for 5 years. That's kind of the chart circulating around, which is kind of crazy. But I was going to ask you guys in terms of kind of circling back into our housing market here and kind of what we chatted about at the beginning of the show, which was, so you've got this like monster inflation print in Canada. It was definitely above expectations, even with the basket being revised. So it kind of surpassed, you know, market or economic forecasting expectations. And then on the day you had like the most watched bond yield in Canada, the Canada 5-year bond yield actually was off on the day, you know, it declined. So is this more so, in your opinion, just the market now pricing in weaker growth and that recession ahead, which is vis-a-vis that, okay, you know, you had another monster print, which means this has to cement a 75 basis point rate hike from the Bank of Canada in July, and that these guys are going to have to push this thing into recession, and thus sort of longer term yields are now falling.
Jeez, I don't know. Keith, you want to get that
am I overthinking this, Keith?
No, I mean, you can see it in the forward in the Fed fund futures rate is that the curve is already starting to head lower.
Well, I just think that's a big deal, given that like we've had basically, you know, again, in Canada, you've had mortgage rates more than double in a span of like 3 months. Like that's like, I think it was the fastest pace on record, actually.
It's the same in the US, which is now 6% on the 30-year mortgage. In the US, you've got a 30-year fixed mortgage. It's now nearly 6%, 5.98.
And purchasing applications for new homes in the US is
cratered.
Yeah, it's cratered. You know, mortgage applications as well, which they track in the US. I wish we tracked that in Canada. Mortgage purchase applications, it's kind of like more of a forward indicator have also collapsed as well. And it's crazy because the US is obviously not even close to as levered as the Canadian housing market. So you can kind of imagine, how our housing market's kind of digesting this. But I think, again, having rates basically double in that short of period, and then to see, okay, maybe have we finally seen that peak in these 5-year fixed rate mortgages, and are we now slowly at least stabilizing or potentially rolling over a bit? Is this a signpost?
Yeah, I think we're going to see Bank of Canada is going to follow the Fed on the same path. So we should get 75 basis points now next month. So remember, I put my foot in for that one last week, right? I'm already down for 75.
I mean, this is going to be another break even on the Twinkie bet.
Okay, I was first in. Okay, but I do suspect central banks will continue to raise rates, but you're going to see the long-term bond to the 10-year in Canada and the 30-year in the US. I think you'll see those rates come off pretty aggressively. So sort of tying in with the oil trade, a lot of people will, they link oil to rates all the time. So you can see a lot of that money going in. So one of the biggest markets that could rally aggressively would be the long bond. So in the US, you can see the yield go from 3% to 2%, just like that. Meanwhile, the Fed and the Bank of Canada are still raising rates. So then they're going to say, okay, now I think we've done enough. So remember, central banks are always chasing their tail. They're trying to be proactive, but they're always reactive. Because if they were proactive, we would never be in this situation where we are. So I think that answers your question, that mortgage rates are set by the yield curve, which are set by longer rates. They could easily come down before the Bank of Canada. However, but you have to put on top of that, though, the credit spread. So, that's something that the banks will overlay on it.
Speaking of Twinkies,
there's
another. Chat with your banker friends on that one, Steve.
Yeah, you get me in trouble again. Did you guys see that that Twinkies has come out with a Twink coin?
Yeah.
So there's now like Twinkies in the shape of like a circle. So individually wrapped Twink coins. So those might be the next bet here. But there's Rich, I know you.
Well, I was going to say on the inflation thing, just another thing that I know we've been wrong about this and maybe a little bit too early, but I don't mind being wrong more than once, obviously, as I just think that there's I think we've reached, I know, forgive me guys, but I think we've reached peak inflation. I think if it's not this month, it's next month, and if it's not month after that, there is sort of, I think that's also what the bond market, I think, is sniffing out, which is it's very, very hard for these base effects to keep rising at 8 and 10%. And I think if you look at prices paid on the ISM PMI, which is from the Purchasing Managers Index, from the ISM, that component of their diffusion index, prices paid, that came off a while ago. If you look at backlogs and sort of order backlogs and that stuff that contribute to those increases in prices, if you look at the rate of change in commodity prices, even the rate of change of oil, which is slowed as a function of you can't, if you go up from 0 to 100, or if you go up from 100 and 120 and you stay at 120, yes, prices are more expensive, but the rate of change has slowed. And I submit to you that in Canada, it's the same thing. The PPI X energy rolled over 9 months ago, and we're starting to see, I think that by the end of the summer, I think inflation picture will be a lot different than it is now. And I think that the bond market is sort of is smelling that out. Whether it's, I don't think it's because the central banks raised rates. I think it's just, that's the way these numbers sort of play out. But that's something I think is worth adding.
You're gonna get dogpiled in the YouTube comment section.
In the comments, because
all the tinfoil hats that say inflation's going to 20%, and you need to get your shotgun and gold bars.
On that, it's just what I think. So I think what people mean to say is that over the last, let's say, 2 years, you've had a massive increase in inflation, and it's not transitory, which I agree. But to have year-on-year inflation stay at 10 and rise to 15 is when you look at the level and you actually punch the math out on your calculator, these numbers, it's incredible, and we're just not seeing that.
Yeah, exactly. And that's kind of just to kind of reiterate to people, we've talked about this on the show before, but we say like inflation is like peaked and it's rolling over. It doesn't mean like absolute prices are coming down.
Right.
Like the steak that you buy at the grocery store isn't going to decline. Instead of that steak rising at 8% per year, it will probably only rise 4%
right
next year and the year following or whatever. So like the levels of change will decelerate.
They'll still be positive, which is definitely not transitory, which is why all those central bankers are a bunch of jackasses.
Yeah, like, well, I mean, like we could be in a period of inflation running at 3.5, 4.5% for the next 2-3 years. Like, sure, why not? And so what are the ramifications of that? I mean,
well, that's important because even if you have a recession, there are times. So this is why this idea that a recession will cure all ills for central bankers is a very, very dangerous one. If you look at like the 1980s, a classic example, you had two recessions in a row, and then a third one not long after that. Yes, they were mild, and inflation was still, yes, inflation slowed, but it was still positive and it was still very high. And so that's, to me, what you might, I hate the word stagflation because I think that's overused, but you have a situation where growth is weak and inflation is still well above, let's say, 5 or 6. I don't know.
Were you referencing earlier the U.S. manufacturing PMI?
Yeah.
Because that came out this morning, didn't it?
Oh, I didn't. No.
Okay, I'll drop a little hint for you on the pod here. No charge.
No, it comes out the first week of I think it's the first week of the month.
Well, that's the one. That's not what Lynn Alden said.
Oh no,
I'm following her on Twitter right now. So
I might have messed up, but
maybe I should get hired here at Acorn Macro.
We'd love to have you.
Consensus economist expectations were for reading of 56 on the manufacturing PMI. Manufacturing PMI came in this morning at 52.
Okay.
52. So you're almost 50. Anything below 50 is contraction, you know?
Yeah, I think it's actually 50. I mean, it's technically, I think it's like 50. Anything below 52 is like, there's the long run. So there's two ways to look at it. One is to compare it to above and below 50, which is the numbers. So it's a diffusion index, which
explain this weird things with Rich. We got 10 minutes. Go.
No, I can't do it. But then a lot of people say, it's about the direction of travel as well. So it's not only whether or not and if another way you're going up or down, it's about the pace at which you're going up and down. And what's cool, if you just type in, ISM PMI manufacturing in your Google machine, you can.
Do you want to explain what that is, by the way, to people? They're like, what the hell is a manufacturing PMI?
So PMI means Purchasing Managers Index, and it's from the Institute of Supply Management, which is a nonprofit, quasi-nonprofit organization that's based out of Arizona, I believe, in the US. And what they do is they ask 4,000 managers questions. And these questions range from, are you hiring or firing? Are your prices that you're paying for your goods going up or down? Is it easier or harder to supply raw materials? Are your lead times going higher or lower? Are you going to spend more money on capital expenditure? Are your new orders, are your export orders going higher or lower? Are your import orders higher or lower? Anyway, so there's a bunch of questions they ask about 4,000 managers, and they collate all of these different items. I think there's 10 or 11 anyways. And then what they do is after they aggregate these, and then they normalize the kind of aggregated view. And why it's a diffusion index is because let's say 9 of the 10 items are going up, you have basically 90, right? And if it's 5 of the 10 items are going up or down, you're at 50. And then effectively why that's useful is because you can normalize this series with sort of a stationary mean of, I think it's 52 or just under 52 right now. And then what that tells you, and then obviously you have the direction, which is it going up or down? And then you have the rate of change of that direction. And what's really powerful about this particular index for the US is that it just starts in 1955. And so you have a lot of data. It's seasonally adjusted, although there's unseasonally adjusted. And then you have a lot of data. The methodology, I imagine, is roughly the same. It's a lead indicator, kind of, although I think people put too much stock into that. But also it tracks the different sort of important criteria that any manufacturing business is looking at it. So just to review: new orders, production, employment, supplier deliveries, inventories, I'm reading it now, prices, backlogs, etc. And then what's cool is that they also do the same thing for non-manufacturing, otherwise known as services. And they ask similar questions, but obviously related to service industries. And then what's also really fascinating, I think, with what I do personally every single month that it comes out, is I actually click on the report, which is freely available for anybody who's interested. And what they do is they actually quote what respondents are saying, which I think is, now people might say that's just anecdotal evidence and you can't use that. And yes, of course it's anecdotal evidence, but the people who at the Institute of Supply Management are not idiots. And they choose the responses from the different industry groups, so chemicals or tobacco or machinery or plastics or whatever, metals or whatever it is, and they ask, and they say, like, for example, I'll just read one now. Like, for machinery, our order books are still strong. Material prices continue to rise. With energy and freight, the underlying influences on our costs are increasing. And so, so those comments sort of add to the data points, and together they provide a really, really powerful picture of not only the specific industry. So in the US, it's about 20% manufacturing and 80% services, but then the industry components, and then the sub-industry groups. And then you can use that to try to predict earnings. It's a really good predictor for earnings in the US. It can be a really good predictor for sales growth in the US. I've used prices paid as an indicator for margins in the US. I mean, so Canada has its own one. In Germany, you've got IFO. In France, you've got the ISEE, which is the national sources. So you got in Japan, it's the Tankan. Fuck, I screwed. Anyway, whatever. and then in China, you've got the Kaishin, which I always screw up saying. And anyway, so every country's got sort of those indicators. And now let me stop anybody who gets sort of delusions of grandeur here. You cannot trade off of these. It's very hard to make money off those specific indicators, but they do give you some real color and flavor for what's going on. And yeah, I think most people in my business really swear by them. Now, of course, there's always pitfalls. Like, for example, when the diffusion index was at 32, it was quickly followed up by the fact that it was an all-time high just a few months after COVID lockdowns were unlocked. And that's just a function of the severe dislocation in that series. Anyways, a long-winded, I hope that was a decent explanation.
What you need to know is
Keith's not so impressed.
This is a highly respected index.
What did I miss, Keith? Come on.
It's signaling crash and burn. No.
But Steve and Rich, when we talk about what is the market looking for to see if we are going to go into recession very quickly or slow, gradual, decline, it is the PMI number. That's what, like, Rich is absolutely correct in emphasizing. Everyone can see this. It comes out monthly, so it's extremely timely. And you don't need to worry too much about the actual number. You want to look at what is the number versus estimates. And the current number that just came out, the actual number was less than estimates, which means, hey, things are slowing or growing less quickly than what people were thinking. So when I say, maybe, we roll off pretty quickly here coming up, it would be in the PMI number. So it would go from, say, 51, 52. The next number would be like 47. And if that happens, the world is gonna shake a little bit. So
there's one more thing. Oh, sorry. There's one other thing is that the market reacts a lot to this number. So that's why I used to work for a hedge fund, And some of the traders would sit around and basically like eat popcorn, watching and waiting for this number to come out, and then immediately look at the reaction of the yen dollar crosses or the euro.
I want
dollar
that job. That
crosses.
sounds fantastic.
or like looking at see how oil prices moved. And if you look at, if you have a daily, if you're rich like Keith and you have a Bloomberg with live prices, you can see the like by minute, if it comes out above expectation or below expectation, you can literally see the tick go jump higher than, you know, than the trend, than it was trending or whatever it is. And you'll see the S&P futures react quickly to that.
We used to bet on the monthly inflation number and PMI because they're monthly, like they were easy to do. If we're bored, we do the weekly job number.
It's the original Twinkie bet.
Yeah.
No, these were for some coffees back in the days.
Oh,
We used to bet on non-farm payrolls. We'd play so non-farm payrolls, for people who don't know, is every month. I think on the first Tuesday of every month, or anyways, now I can't remember for some reason. The first Friday of every month or whatever, they produce the employment figures for the previous month. Anyways, so we would bet on those, but
we need to ramp up more Twinkie bets here.
Yeah.
Give the people what they want. We'll have to start betting on various random data sets. How much free money Krista Freeland can pump out. You got to guess the number every week. All right. Well, I think that's a good place to wrap it up. As always, we appreciate your guys' support as we continue to build this Loonie Hour community. A lot of exciting things in the works for the pod here. So all we ask is that you continue to share this episode with at least one person, and let's build this Loonie Hour community one by one. So as always, appreciate your support, and we'll see you next week.